Hi friends, we are discussing about taxation and tax saving in series of video. Now we are going to discuss and see the section 80C in income tax and what are the investment options are there in 80C. Welcome to our channel Stocks in Silence. In part 2, we started with the history of taxation in ancient India and modern India. Finally, we end up with income tax. In part 1, we discussed about the history of global taxation. Part 1 and part 2 videos are given in description. Please visit if you have not yet seen those videos. That will be very useful videos to you. So in income tax, there are different sections are there. 80C, 80CCC, 80CCD, 80TTA, 80GG, 80E and 80EE, 80D. Today we are going to see section 80C and its investment options. First, let us see what common expenses are in our family. School fees for children, interest paid for education loan, premium for medical insurance, then medical insurance for parents, then preventive health checkup, the expense for health checkup, medical expense for specific diseases, interest for home loan, and then donation, then finally the house rent. So each sections and the maximum exemption amount in each sections are mentioned here. You can take a screenshot for your ready reference at any time. So now you are seeing the tax slab for financial year 22. There are three categories: resident of India under 60 years, senior citizen and very senior citizen. Many people may heard about senior citizen, but most of us don't know about very senior citizen, that is 80 years and above called as very senior citizen, and 60 years to 79 years old person called as a senior citizen. There are two tax regimes, old and new. New tax regime was announced in the budget 2020 with lower slab rate. You can choose any one, either old regime or new regime according to your wish, and there is no compulsion. Both the categories are explains the tax slabs for all three age categories, that is under 60, senior citizen and very senior citizen. According to your income, the taxable amount differs and you are seeing the different tax slabs. In new tax regime, the popular section 80C and house rent allowances are not available. So you can take screenshot of this page also for your quick reference. In section 80C, different expenses or savings can be considered for tax deduction. LIC premium payment, employee provident fund, school fees, and then principal repayment of home loan, children's tuition fees, investment in Sukanya Samriddhi, ULIPs, ELSS, sum paid to purchase deferred annuity, 5 years fixed deposit scheme, then senior citizens saving scheme, so many things, contribution to notified pension fund, subscription to home loan account scheme of the National Housing Bank, subscription to deposit scheme of public sector or company engaged in providing housing finance, contribution to notified annuity plan of LIC, subscription to notified bonds. So these are the many options are there to get exemption, but in as per the 80C, the maximum allowed limit is 1.5 lakh. Though there are many categories, most of the people who are under 60 will prefer these 6 categories. In general, we call it as Super 6 saving options. Those are all ELSS, that is equity linked saving scheme. Next, second one is ULIP, unit linked insurance plan. Third, NSC, National Savings Certificate. Fourth, FDs, that is 5-year bank fixed deposits. Fifth, SSY, that is Sukanya Samriddhi Yojana for girls. Then finally PPF, Public Provident Fund. Now we will see the advantages and the risk factors in those 6 categories one by one. ELSS funds, first we'll see the fund name, then what is the average interest as of now we are getting, then what is the lock-in period for those funds, then finally what is the risk factor, that is minimum, high or medium. First, if you see the ELSS funds, the average interest would be 10% to 12%. Lock-in period is 3 years. The risk factor is high because it is related to the equity. The next one is NPS, National Pension Scheme. Average interest is 6.8%. The lock-in period is till 60 years of your age. Risk factor is high because this also linked to the equity. Third one is ULIP. Average interest is 6% to 7%. Lock-in period is 5 years. Risk factor is low because it is related to insurance. Then tax saving fixed deposit, the interest rate is 5.4%. Lock-in period is 5 years. Risk factor is low because this is simple fixed deposit. Then PPF, 7.1% interest, 5 years lock-in period. Risk factor is medium. Sukanya Samriddhi Yojana, 7.6% as of today. It was started in 2014-15 around 9.2% interest, but the interest rate is keep on reduced year by year. This is especially for the girl child reaches 21 years of age. So partial withdrawal allowed when she reached 18 years. So the risk factor is, we can say, is a moderate because it's like another type of fixed deposit for the long time. So we have seen one by one the all 6 categories. Apart from the super 6 options which we have discussed, one more good option is Atal Pension Yojana. This scheme is named to honor the previous Prime Minister Atal Bihari Vajpayee. This is the type of pension scheme. Lock-in period is till 60 years of age. There are different tiers like tier 1 equity plans, tier 1 government bond plans, and tier 1 corporate debt plans. So each tier have different percentage of returns. For example, tier 1 equity plans around 15.81%, tier 1 government bond plans 7.81%, and tier 1 corporate debt plans 8.21%. So monthly pension will vary depending upon the scheme which you have chosen. Taxability on returns depends upon your other income and which slab you are in for the tax. The investment amount will vary based on your entry age and the scheme what you have chosen. So now, why do we go for the ELSS? ELSS meaning already we have discussed equity linked savings scheme. An equity linked savings scheme is an open-ended equity mutual fund that invests the majority of funds in equity and enjoys the benefit of tax exemption under the section 80C of the Income Tax Act. Lock-in period we just discussed 3 years. Minimum investments is just 500 rupees. You can start the SIP, systematic investment plan, by using just 500 rupees. So maximum investment, there is no limit. You can invest crores and crores whatever you have. 80C deductions we have seen just now. The maximum deduction is 1.5 lakhs. Dividend is not taxable. Taxation, long-term capital gain tax is not free. Previously it was free. Then the government has amended in last budget. 10% long-term capital gain, that also if you are gaining more than 1 lakh per year. Now the value of money will decrease due to the inflations over the period of time, that everyone knows. For example, if you have 1 lakh in the year of 2021, it is going to become 11,468 rupees in 2056. This is due to inflation. So saving is very much important. Tax and inflation is biggest enemy to middle class people. The small saving at early age is very important. We have published the details of video on signs of small saving. We elaborately discussed about the inflations and how to save, and in different age, if we want to reach 1 crore, where to start, when to start, and what amount we are going to get if you start the saving at the earlier age. During the retirement time, how much amount we are going to get. So all the details we have discussed on those video. The link is given in description. I request you to watch that video also. Now you are seeing the best performed ELSS mutual funds in last 5 years. The maximum return from Quant Tax Fund, and then Mirae Asset Tax Saving Fund, and then PGIM, and then DSP Tax Saver. The returns from all the funds are more than 17%. You can see in last 5 years. The quantum tax plan has given almost 25.58%. In first year 60.93. The next one is Mirae Asset 21.55. So in that way you can understand that if you invest in ELSS mutual fund over the period of 5 years, at least you can get more than 17% of return. So it is always good to look the long-term performance of mutual fund. See the performance of Quant Tax Fund even over the period of 10 years. Still the Quant Tax plan is number one return performer. Just for the example, if you would have invested for 10 years, so 21.44% returns per annum. So if you would have invested rupees 10,000 monthly in SIP, so you would have get 43.3 lakhs. If you add 10% of early increment, the amount would be 60.88 lakhs. So you can understand the power of a mutual fund which is linked to the equity. So here this graph shows that how ELSS is better than PPF. We are comparing the returns from PPF and ELS over the period of 15 years. To get 1.5 lakhs exemption in section 80C, we should invest at least 12,500 rupees per month, either in ELSS or PPF. In 15 years, if we invest slowly 22.5 lakhs from our hand, this 22.5 lakh will become 43.54 lakh if you would have invested in PPF. This is calculated as per the current interest rate. At the same time, if you would have invested in best performed ELSS fund, the return would be 73.05 lakhs. Again, this is the power of ELSS, that is equity linked funds. Finally, the mistake what we should avoid when we invest in ELSS fund is, the first point is, don't just look at the returns, because the returns, it may be 15% or 14% or 17%, whatever it is, but don't just think about only the returns. We are investing only for long-term gain. So don't decide and don't look the returns. Second point is, don't redeem just after the lock-in. Most of the people doing this activity because they thought they have chosen 3 years lock-in period. Now the 3 years lock-in period is completed. Immediately they might have redeemed the entire amount. Don't do that, because our aim is long-term investment. The third one is, don't change funds after every 3 years, because if you have identified a good fund, at least keep invest fund for at least 10 years. That will give a good return over the period of time. Finally, don't invest in ELSS only for tax saving. This also many people, they are doing mistake. They think about this is just for tax saving. No, this is, you are creating a wealth over the period of long time, as well as in every year you are getting the tax benefit. So we always have to think about the long term. We should not think about the short term. I hope that you may like this video. Please subscribe if you like this video and forward to your friends and relatives. Thank you. Have a good day. Bye bye.